Begin with, what is TIF? TIF is a method of capturing tax-based growth resulting from new development. TIF captures new local taxes, the increment, to pay for public improvements related to the development. It's for a fixed term there's a fixed term for the capture, and then following that term, then the new development is added to the tax base. Tax increment financing is defined by state statute 469-174 through 469-1799. If you ever want anything good to read at night, read that, you'll fall right asleep. We can belabor all the individual points of that, or we can go over what this is, which is just going to be a general 1,000 feet overview. TIF is a gap financing tool. It's used to solve a financial gap in a proposed development where the sources of revenue are unable to meet the uses and all the costs of development. And depending on the year created, there are different compliance requirements in place. And it's used mainly by cities and counties, and it provides incentive for development. A couple of the variables and definitions for tax increment financing are the base value, which is the pre-development value, the current land or current value of the property. The estimated market value, which is going to be the post-development value. What is the tax value and tax base going to be on that site after development? The net tax capacity, which is a way of determining the difference between the two. Tax classification rates, tax capacity rates. And then tax increment is the difference between property taxes without new development without new development to property taxes with new development. That's a mouthful, and we'll get to explaining that a little bit more detailed later. First, we want to just start with how our property tax is calculated. I call this the Minnesota two-step. It's a two-step process. It's something that's applied by a number of states use this type of approach. You start off with, you have your taxable market value. This is the general market value that gets applied to every parcel in the city. Everybody's got a market value, and it's apples to apples between various parcels. For here, we're using just a hypothetical $250,000 property. And when you take that market value, you apply a class rate. And the class rate is specific to the type of use of property. Here, we're assuming a rental property, and the class rates are set by the state. They're the same for every city in the state. They're set by the state, and they're changed very rarely. The last time was back in the early 2000s. They were adjusted. The class rate equalizes values based off of use. If you've ever looked at two parcels that have the same value, but they're, one's a residential unit and one's a rental unit, and then you assume they're both $250,000, and then you go to look at the tax bill and they have two different amounts. This is where that comes into application. It's the rental, or the class rate varies based off the type of use. For rental, it's 1.25%, and for, say, housing under $500,000, it's 1%. For businesses, it's 1.5%. It's variable based on the type of use. So you take your market value times your class rate, and that gets you to your net tax capacity. In this case, $250,000 times 1.25 is $3,125. That gives us our taxable net tax capacity. This is the amount that the local tax rate is applied against. So the local tax rate in this case is 119,778%, or 119,778%. And this is the sum for all the entities in Maplewood, City of Maplewood, Ramsey County, School District, watersheds. They all total 119%. So the tax capacity times the tax rate brings us to our actual taxes. So that's how you get from a market value amount to an actual taxable bill. All right. Okay.
This is a comparison between low-tech and high-tech.
Yes.
So we've just gone to high-tech now.
I was perfectly happy with low-tech.
All right, for net tax, okay, so how is TIF calculated? TIF starts out with the net tax capacity from the existing land and building value, which is called the original net tax capacity, after conversion from the base value. Property taxes generated by the ONTC of the TIF district continue to flow in individual taxing jurisdictions, such as the city, county, independent school district. And then net tax capacity growth above the original net tax capacity is captured by the TIF districts and generates tax increment. Okay, that is a mouthful. This explains it a lot better, a lot simpler, and visually. Again, we're